Here. And next is fixed asset account. Fixed asset account without provision for depreciation. You have to prepare the fixed asset account, that is machinery account, patent machinery account, furniture account, then building account, plant account. Like that, you have to prepare some accounts. If there is a confusion regarding purchase and sale or depreciation, if the on the basis of given amount, if you are able to find the purchase and sale, there is no need of opening the account. But if there is a confusion, you have to prepare the account. Okay. If provision for depreciation is not given the problem, how to prepare the account? Particular amount. This account starts with opening balance. To balance brought down means it is the previous year balance. You take the previous year balance as to balance brought down. Okay. Then by balance carried down. This is the balance of the current year. Last year balance, current year balance. To balance, by balance carried down. Okay. After writing these two, you go to the adjustment. You go to the adjustment if the sale is given in the problem. Sale is given in the problem. For example, sale of machinery. If sale of machinery is there, write that by bank. You take the sale amount. Okay, sale amount. And secondly, you take the depreciation on that sold asset. Depreciation on the sold asset you take. After taking the depreciation on the sold asset, then you calculate the profit or loss on the sale. You calculate profit or loss on the sale. If there is a loss on sale of that asset is there, then record by loss on sale here only. Okay, you write the loss on sale here only. If there is a profit on sale of asset is there, you write on the debit side. Okay, you write on the debit side. And then you write the depreciation for the year. Depreciation for the year. Current year depreciation you write. Okay. If you write the current year depreciation, the part completes. Okay. What you have to do? You take the sale value of asset, depreciation on the sold asset, profit or loss you calculate. Profit comes from the debit side, loss comes from the credit side. Then whatever total depreciation charge at the end of the year you take, and the total of the credit side completed. Take the total of the account, whatever difference comes, debit side, that is called as to bank. To bank means it is a purchase of asset. Purchase of asset. Okay, so you remember the purchase of asset is a application, sale of asset is a source. So this bank is application, sale of asset is source, and purchase of asset is application. So you write to bank and bracket purchase, and credit side also by bank you write sale. Clear? And close the account, take the total. Total first you have to make, and thereafter balancing figure is called as to bank. In this way you complete the fixed asset and find out the purchase of asset if the sale is given in the problem. If the sale of asset is given in the problem, you have to calculate purchase of asset. In this way, you complete this account. Okay, thereafter, if the provision for depreciation account is there, if the provision for depreciation account is there, then you have to prepare the account like this. Okay, you take the to balance brought down, opening balance, it is the last year account balance, last year balance. Then by balance carried down, this is the current year balance. Remember this. Okay, thereafter you write the bank sale. Then you write the by depreciation on sold. By depreciation on sold. And if there is a profit or loss, you write the profit on the debit side, loss on the credit side. Clear? Loss on the credit side. Remember this. I have not recorded here. The same amount, above amount comes here. Depreciation on sold asset. And then you have to prepare You write the loss on sale of the, sorry, profit on sale. It is not a loss on sale, it is profit on sale. Okay. Depreciation, you write. Debit side, profit on sale, you write. Thereafter, you close the account. Whatever difference comes, that is called as to bank purchase of asset. Purchase of asset. Like this, you have to complete. Clear. And year-end depreciation, you don't write here. Year-end depreciation, don't write here. That is to be recorded in provision for depreciation account. You see here provision for depreciation account. In the provision for depreciation account, first you have to write buy balance brought down. It is a liability account. So it starts from credit side. Buy balance brought down, you take the last year provision for depreciation. To balance carried down, current year provision. You write to fixed asset account. To fixed asset account means it is the depreciation recorded in the above. This amount comes here. Okay, remember this. This amount comes here. You write that depreciation, or you write by depreciation, provision for depreciation here. And same amount you write here. Okay, you remember this. This fixed asset account, depreciation recorded in the asset. Okay. And after writing this depreciation, you close the account, and whatever difference comes, this difference is called as buy P&L account. Buy P&L account means it is the current year provision for depreciation. This is the current year provision for depreciation. Remember this. Okay. Clear. In this way, you have to prepare the account. Remember this. If provision for depreciation is not given in the problem, only one account you have to prepare. Provision for depreciation is there, you have to prepare two accounts. One is asset account, second is provision for depreciation account. Okay. And in the asset account, sale of asset, profit or sale loss, then depreciation on that asset up to the date of sale, you have to take. And the same depreciation you have to record in the debit side of provision account as asset account. And close the provision account, find out the difference. The difference is called as P&L account. That is called as current year provision for depreciation. Remember this. This is current year provision, goes to funds from operation. Clear? Remember this. Okay. This is regarding the fixed asset account. Next is provision for income tax account. Okay. This provision for income tax account you prepare only when adjustment is there in the problem. If there is adjustment, you prepare this account. Otherwise, you don't prepare the account. You take it in the changes in working capital. Okay. If there is adjustment, you prepare the account. So this is the provision for tax account. Provision for tax account. Okay. First, you write buy balance brought down. Buy balance brought down, it is the opening balance last year amount. It is last year column, previous year column. Then to balance carried down, this is the current year amount. Like this, you write the buy balance brought down, to balance carried down. Two items you write. And see the adjustment. In the adjustment, any one item they will give. Provision for income tax. Provision for current year provision for income tax, they will give you. Otherwise, they will give you tax paid during the year. Current year tax paid. Provision or tax paid, any one item, they will give you in the adjustment. Okay. When provision for tax is given, you write as buy P&L account. Buy P&L account. Okay. If tax paid is given in the problem, you write to bank account, clear, and close the account. If tax paid is given, you will get the, you have to ascertain provision. If provision is given, you have to calculate tax paid. Okay, you see here, to bank account, tax paid is given in the problem. Let us consider tax paid is given in the problem. Then you write to bank, you write the amount here. Okay, then you take the total of this column. Take the total of the debit side and credit side. Then difference, whatever comes, that difference is called as by P&L account. By P&L account means it is the current year provision. Okay, if current year provision is given, write by P&L and ascertain to bank. This is the provision for income tax account. In the same way, proposed dividend account. Proposed dividend account. Use here. In the proposed dividend account also, you write by balance brought down, to balance carried down. By balance brought down means this is the last year account balance, previous year amount. To balance carried down means current year amount. Okay. Then go to adjustment. If proposed dividend is given in the problem, write by P&L. By P&L. If dividend paid is given in the problem, write to bank. Okay. And ascertain the another amount. Ascertain the another amount by closing the account. To bank, dividend paid. You write like this. Close the account by P&L. This is proposed dividend. Proposed dividend. Okay. And closes. And remember, these two, P&L account, P&L account. This P&L account goes to a fund from operation statement. Fund from operation statement. In the fund from operation statement, you take by P&L. That is provision for tax, provision for proposed dividend. Fund from operation. And to bank, dividend paid, tax paid. These are the applications comes in the statement of fund flow, application side. Application side. These two goes to application side. These two go to funds from operation. Okay. Remember this. These are the accounts you have to prepare. After preparing these accounts, then statement showing funds from operation. Funds from operation. Particular amount. Like that you have to prepare. First, you take the closing balance of net profit. Closing balance of net profit means current year P&L account balance. Current year P&L account balance you write to the outer column. You write the current year balance in the outer column. Okay. Then next, add non-operating and non-cash expenses. Non-operating and non-cash expenses means the expense is not related to your operation, your business. And non-cash means expense related with the business, but not related, not paid in cash. Those items you have to sort out and record in this head. For example, depreciation. Depreciation is related with business, but it is not paid in cash. Then next is provisions. All provision. Provision for bad debt, provision for tax, provision for proposed dividend, all the provisions you have to take. Okay. Next, fictitious assets written off. Fictitious asset written off means goodwill written off, patent written off, copyright written off, preliminary expense written off. Like that, if there is a writing off of the fictitious asset, goodwill, preliminary expense, patent, copyright, written down value, written down. Write off value you take, written off. Then interest paid. Interest paid is in the form of cash, but it is not related to business. Then interim dividend. Interim dividend is paid in cash, but is not related to business. So you have to note. Transfer to transfer of profit to general reserve and other reserve. Appropriations made. All the appropriations made you have to note down. Transfer to general reserve, transfer to sinking fund, transfer to proposed dividend, like that all transfers from profit to appropriations you record. Then loss on sale of capital asset. Loss on sale of building, loss on sale of machinery, loss on sale of patent, loss on sale of furniture, like that. Whatever loss on sale of capital asset is there, you take that. Okay. Next is discount on issue of shares and debentures. If the discount is given during the issue of shares and debentures, that is the not relating to operation. So you take that. Premium on redemption of debenture. If the debenture is repaid at premium, then there is a loss. That loss you take here. Okay. Next, any other such items. Non-cash, non-operating. Item is there, you take it. And all these items total you take to the outer column and take the outer column total. Thereafter, less non-operating and non-cash incomes. Non-operating incomes, non-cash incomes, not related to your business. Interest and dividend received. Interest and dividend received is not related to your operation. Profit and sale of asset. That means profit and sale of building, profit and sale of furniture, profit on sale of plant, profit on sale of equipment, like that. All profit on sale of assets you take here. Then premium on issue of shares and debenture. If the shares and debentures are issued at premium and that is included in P&L account, that is not related to operation. Then discount on redemption. While repayment of the debentures, if the debentures are repaid at low rate, that is income. That is not related to business. Okay. And capital nature receipts. If there are any capital nature receipts, they are not related to business, you take them. Okay. And last item is opening balance of net profit. Opening balance of net profit means it is the closing balance of last year. Closing balance of last year you take and take the total to the outer column. In the outer column you deduct. Whatever comes, that is called as funds from operation. Funds from operation. Okay. And provision for tax, proposed dividend, you have to take in the add heading. Remember this. Clear? This is the funds from operation. Funds from operation. Then last statement is fund flow statement. In the fund flow statement, there are two parts. One is source, another is application. Source means from where you received the cash, how you received the fund, from which head you received the fund. Source of fund, where you applied the fund. That is the item you have to write. First is fund from operation. Fund from operation means profit from business. Profit from business. That is the third statement, answer you take. If there is loss in that, loss from operation. Minus is there, you take on the application side. Okay, fund from operation comes on source, loss from operation, application. Thereafter, you write purchase of fixed asset. If asset is purchased, that is called as application. Sale is there, that is source. Purchase of fixed asset, land, building, furniture, machinery, so application. Sale of land, building, furniture, equipment, source of fund. Source side, application side. Long-term investments made. If you made the investments, then that is the application. Long-term investment realized. If you sell the long-term investments and collected the amount, that is source. Okay. Then long-term loan repaid. If loan is repaid, that is called as application. If loan is taken, that is called as source. Source. Then redemption of shares and debenture. If you repay the preference shares and debentures, if you repay the preference share and debenture, that is called as application. Issue of shares and debentures is the source of fund. Source of fund. Okay. Then non-operating incomes. Any other non-operating income. For example, dividend received is a source. Interest received is a source. Like that. Dividend received, interest received. You take them in the source side. Income tax paid you have to take here. Income tax paid. This amount you have to take from the income tax provision account. Bank. Already I explained. Interim dividend paid. Dividend paid. Remember these two items. Dividend paid, income tax paid. These two items you have to take from the proposed dividend and provision for income tax account. Otherwise, no. Okay, use here. Income tax paid, dividend paid. Means bank account item, debit side in the account comes here. Provision for income tax, proposed dividend comes in the funds from operation. This is the point you remember. Non-operating expenses. It is expense, not income. Non-operating expense. Non-operating expense means interest paid is not related to business. Payment is there, that is the application. Like that you have to take. Okay. After this, you have to close the account. Difference. Whatever difference comes, that may be decrease in the working capital or increase in working capital. Okay. So take the total. Difference, whatever difference comes. If the difference is there, increase in working capital is the application. Decrease in working capital is the source. Remember this. Okay, decrease in working capital, you write in the source side. I'll write use here. If the difference comes here, the difference you record as decrease in working capital. Working capital. Record as decrease in working capital. Okay. If the difference comes this side, if the difference comes credit side, right? Increase in working capital. Increase in working capital. And that must be same as per the first statement. Otherwise, you take from the first statement here, source side decrease in working capital, application side increase in working capital, and the statement must be equal. The statement must be equal. Remember this. This is the theory part connected with. This is theory part connected with your funds flow statement. In this way, you have to prepare the fund flow statement. Okay.